30 minutes until the start of trading. I'm Matt Miller.
I'm Dani Berger. Bloomberg Open Interest starts right now.
Coming up, JPMorgan's Jamie Dimon ushers in earnings season with a bullish call on the U.S. economy and a warning on Fed independence.
Meanwhile, Delta disappoints. A cloudy outlook weighs on the airline and its rivals in the year ahead.
Plus, CPI surprise, I should say. Fresh inflation data shows signs that price pressures are gradually easing.
So the stocks we're looking at, we mentioned them. JPMorgan is the big one, I guess, kind of unofficially kicking off the start to their earnings season. The stock's kind of been all over the place in the pre-market, up, down. Now it's unchanged. Most of their estimates were higher than what, most of their outlooks and the current quarter were higher than estimated. I was listening to the media call, and the CFO was very, very firm on what it would mean on Trump's call for 10% on credit card rates, basically saying it's bad for the economy, it's bad for business, all options are on the table, we'd have to change things. Didn't want to quantify how much it would cost, but basically saying, yeah, this is really bad.
Right. I think a senator said weapons grade stupid, although he was talking about something else. But I love that phrase. We're going to be using it a lot today. Delta earnings beat analyst estimates, but its annual profit outlook underwhelmed. The airline also announced its first ever purchase of Boeing 787 Dreamliner jets. The shares down 4%, but suffice to say, we're kicking off earnings season big time, Dani.
Yeah, we are. And even though there's that back and forth, equity is slightly higher, not as high as they were when we initially got December's weaker than expected CPI. Could it help the case for the Fed to cut interest rates later this year? Joining us is Michael McKee, Bloomberg's international economics and policy correspondent. Mike, what do we get?
Well, we got a kind of a mixed picture, cats and dogs kind of report here. We had some surprises in both directions. The general consensus was we might see a little bit higher inflation because of the data collection problems that they had in October and November, but instead we come on bang on estimates basically, and we don't see any change at all in the year-over-year numbers, 2.7 for headline, 2.6 for core. If you go under the hood, there are some things that were expected and some things that were not expected. Expected airfares, they were up 5.2%. Hotels were up 3.5%. Electricity was only up 0.1%. Natural gas up 4.4%. But then you got some surprises like appliances, which certainly the components have been tariffed, down 4.3%. Used cars was not a surprise, down 1.1%, but new cars were flat. We're going to wait and see January. Matt would know more about this, whether that's the month where all the car companies raise prices because it's a flip over into a new model year.
Well, no, they have been throughout the year. I think one time for price increases is gone now. Because they've got to do it stealthily, right? They have to make it look like it's not tariff-driven. Also, they want to make more money. So, by the way, President Trump is going to be visiting the Ford factory in Detroit today. You know, my question is more about not the CPI print today, because we have the data and you can see how markets reacted, but John Williams' speech yesterday, he said he thinks inflation is going to peak in the first half around 2.75 to 3%. We're already there, essentially, and then go down to 2.5% for the full year, which is still 25% more than the Fed's target. He said unemployment is going to stabilize. We're at 4.4%, which is very low. He said it's going to go lower in the years ahead from there. So if the labor market is that tight and we're like net zero or negative on population growth, how come lower unemployment rate doesn't push inflation higher?
Well, that's a very good question. There are people who are saying basically that the Fed's logic doesn't necessarily hang together, and we're going to have to see how that plays out. The problem for the Fed, of course, is that the data are very noisy, especially now. Even with the numbers we got a full month of December numbers, but because of October and November, there are going to be ongoing problems for a couple of months. So the Fed's going to have to look under the hood of that and try to really get a much better, a kind of a clean read as best they can on inflation. And then we still don't know what's going to happen with employment because we don't know, A, what's going to happen with AI, and B, what's going to happen with companies who are still trying to figure out what the president's economic policies and tariffs are.
All right, Mike McKee, our policy and economics correspondent. we're going to be talking to you more about what we see in these numbers and how the market has reacted and whether or not the Fed will be using this as an excuse to cut further. JPMorgan kicking off earnings on Wall Street, posting better than expected trading revenue and net interest income estimates. CEO Jamie Dimon giving an upbeat macro outlook and weighing in on Fed independence. Bloomberg finance reporter Catherine Doherty joins us now. So I thought trading would be weaker, and it turns out trading is still good, but it's investment banking advisory that's not great.
Yes, trading is steady. This is a continuation of the narrative we've been seeing for the first 3 quarters of the year. So 2025 overall, the trading desks were seeing a lot more activity. This is just because of the repositioning throughout the year. People are usually in the last months of 2025 having to look ahead, and that causes sometimes a more active quarter. So that's what we saw for JPMorgan. Investment banking, a surprise decline. The firm in December had given previous guidance that they would be slightly up. We saw the results today slightly down. They're saying that's because of deals that were being held or pushed out to 2026. So although it's a downbeat end for investment banking in the quarter, looking ahead, there's a sign of optimism. They are saying that activity, discussions with clients is still very active. Their pipeline is strong. We're getting a few more details on the calls today with media and with analysts talking about the road ahead. So that's really what we're going to be looking for. It's the signs of 2026 and not just how the end of 2025 went.
I got to say, Jeremy Barnum, the CFO's comments on credit cards were extremely blunt. I'd be interested to see whether the other big banks say the same thing, saying that he won't even go as far as to quantify the hit because it's so uncertain and it would be so bad. They just bought the Apple credit card from Goldman. Are they going to live to regret now expanding their credit card business when it could be coming under threat?
They, on the call right now with analysts, are very optimistic about this deal. They did say that it's going to take a lot of integration, 2 years is, I believe, the time frame that they're giving. So this is not an automatic switch. This is not going to be profit right off the bat. But in the long term, they're seeing this as a strategic pivot. It's more customers that they have access to. Cards is a big part of their business. But you're absolutely correct in the sentiment as in terms of the warning to President Trump and to the administration on this proposed 10% cap on credit card rates. Jeremy Barnum today, these are his words, he's saying that there's way too much uncertainty around this proposal. That's why they're not quantifying the potential hit. But he's warning, he's saying everything is on the table, and he's pushing back on this potential proposal. There's a lot of details that need to be ironed out, and that is what the executives today are noting. But overall, they're saying that it's weakly supported derivatives to radically change the business. This is Barnum's words today. So he's giving a warning saying, well, we're going to have to pivot if this is the road ahead that you are paving for us.
He's calling the president's tweets weakly supported directives.
I mean,
and he's saying everything is on the table in terms of pushing back.
Absolutely.
Saying okay, maybe we'll just cancel credit for the bottom 90% of Americans.
No, he was clear on that. He's like, less credit becomes available. That is the net outcome. Again, it was remarkable that you have C-suites that are willing to push back against the president. And maybe it was directed towards the audience of the president saying, hey, this isn't just bad for us. This is bad for consumers and the economy.
And their clients.
Yeah. For certain. Hey, Catherine, thank you so much for helping us cover this. More bank earnings ahead. Looking forward to continuing the conversation this week, Catherine Doherty. Now, other earnings, Delta shares, those are declining. The airline issued a profit forecast that fell short of Wall Street estimates. Sid Phillips is Bloomberg's chief global aviation correspondent. Sid, also had Bastian saying that all the growth is coming from premium. I mean, how much is this feeding into a disappointing set of results from Delta?
So for Delta, this is they've talked about how this is a record revenue this year. They had really good, they beat expectations on their results, but at the same time, they're being cautious amid the geopolitical pressures that they're facing and they're seeing at the moment. I mean, they talked about how travel from China and Canada into the US hasn't really recovered back to sort of the pre-pandemic levels. And I think that's also because of the current geopolitical uncertainty that's sort of affecting the market. Still, the airline's talking about how they're sort of doubling down on premium. They just placed a massive order for 30 787s with options for another 30, and they're sort of talking about how their seat capacity growth all going to be on premium. So Delta is really doubling down on premium, especially at a time when there's so much uncertainty in the market.
Maybe they'll finally give business class travelers from New York to Seattle lie flat seats. Because paying $5,000 to sit upright just doesn't cut it. It doesn't cut it for such a long flight. No, but he's leaning into the K-shaped economy, isn't he? He's saying, like, we're going to get all of our money from rich people. Oh, and by the way, the future is international. I thought it was the 50s again. The future is international travel. Wow.
So Delta has sort of leaned into the K-shaped economy. I mean, Delta was one of the first airlines to call out the K-shaped economy, saying that they were going to go after the well-heeled passengers who are not really affected by cost of living and not really concerned, because I mean the bottom end of the market has seen lots of like people canceling trips and people sort of saying, hey, ticket prices are too expensive, I'm going to hold off on going on holiday, especially at these uncertain times. And that's really affected the ultra low cost carriers like the likes of Southwest. It's affected the likes of Spirit Airlines and JetBlue. And so for Delta, their customers are doing really well. They talked about how their customers earn over $100,000 a year, and so their customer profile is different from the other carriers. And they're sort of leaning into that and saying that we're going to keep these customers by offering them more amenities, offering them better services both in the air and in the ground, and sort of talking about your lie flat seats. They might actually turn up because they're sort of trying to keep those customers happy who are willing to pay money, $5,000 on lie flat seats.
All right, Sid, thanks so much for joining us. Bloomberg's Sid Phillip there talking Delta. Tomorrow at 8 a.m., Bloomberg sits down with Delta CEO Ed Bastian from the company's headquarters. I imagine Lisa Abramowitz will be there. Check on futures right now. We're looking at a market that's fluctuating between gains and losses in terms of the index level. We still have about 19 minutes to go, as you can see there, as you saw briefly. If you blink, you missed it from the countdown clock. But 0.1% is the gain on the S&P futures. NASDAQ futures gaining even less here. Interesting that the Russell is doing better in terms of futures, because the CPI number leads one to believe that we could get potentially, or the chances higher now of getting a rate cut at the next meeting.
Yeah, which would be good for small caps, right?
Yeah,
so,
exactly.
I mean, the rally continues. By the way, some other movers on our radar. BNY Mellon profit beat analyst estimates, driven by gains in fee revenue and interest income. Those shares a little change this morning.
U.S. Bancorp, the largest regional bank, will acquire brokerage BTIG for $1 billion.
And is this company L3 Harris?
Yes.
I guess that's how you say the name.
Yep.
Will spin off its missile unit as the Department of Defense invests $1 billion to build rocket motors for missiles.
Wow, it is the 50s. Coming up, Meta is cutting more than 1,000 jobs as it shifts away from the metaverse. We'll talk tech next. This is Bloomberg Open Interest. Let's get to high interest. Look at what's making headlines around the world. Hedge funds are cashing in on chaos, posting their best returns in 16 years. The industry gained about 12.6% as AI mania, global conflict, and rate uncertainty supercharged volatility. Power players like Bridgewater, Citadel, and D.E. Shaw notched double-digit gains, pulling in $71 billion after a decade of investor exits. And Morgan Stanley is lifting bonuses for bankers in Asia and Europe after a bumper year that was fueled by trading and deal making. Asia payouts rose about 20% as regional revenue neared a record $10 billion. In London and Europe, bonuses climbed 10% to 15%, with top managing directors earning up to $2.5 million in bonuses. This seems like it was a good quarter for bankers, at least overseas. And the CFA Institute says the level 1 exam pass rate held steady at 43% in November, above the decade average of 41%. First-time test takers did far better with a 49% pass rate, while the pass rate for candidates who deferred at least once was only 29%. The Institute says staying on schedule remains one of the strongest predictors, Dani, of success.
Congrats to all those who passed. Elsewhere, Meta is cutting more than 1,000 jobs at its Reality Labs unit as it shifts money away from some virtual reality products and into AI wearables. Bloomberg Tech's Caroline Hyde joins us now. So sad we're not going to all get to be in the metaverse with Mark Zuckerberg's corny little avatar. So sad, but I guess this is not.
You weren't there already? I've only been in that world. You've been missing out. Horizons is blast.
Oh, I am sure. I'm sure of it, Caroline. I mean, is this surprising? Feels like they've just been really shifting their resources towards AI.
Not surprising, and Kurt Wagner, our reporter, has been really on top of this ever since December, showing that at one point we were thinking 30% cuts could come from that particular part of the metaverse push. But they are just reorientating. This is 15,000 people in this particular unit. So if you're cutting about 10%, you're looking at 1,000, 1,500 people. But really, they're trying to go all in on where's working. The AI glasses are working. They are far more popular than many had anticipated. The way in which you can put on your Meta Ray-Ban glasses, wander around, and it will come seamlessly into your ears and be able to listen to what you're looking at, be able to have like in real-time translation. That's working. So they shift more of the resources to that. They move out of the idea that we're all going to be playing and working out in a virtual reality for now, and instead they focus actually on your phone. That's where our VR experience is probably going to come. That's where our avatars are going to live. For the here and now, Andrew Bosworth, the CTO, is saying, look, we're going to pile back in really to the artificial intelligence ploy on all of this and just reorientate some of our skills. So I think that's really where they got the message that people weren't ready for virtual reality. They weren't ready for 2021 metaverse pivot. They weren't ready for it to be called Meta, and they certainly weren't ready for $70 billion to be spent on it when you and I weren't really buying into it yet.
I want to pivot a bit because President Trump yesterday tweeted out that he doesn't want consumers picking up the tab for AI data center electricity bills. And apparently he spoke with Microsoft, and now they've vowed to pay their costs.
Yeah, chicken and the egg. Who came first? Was Microsoft being more civic duty and then Trump got on the back of this, or vice versa? But what is clear is this has become a political issue. If you live in Virginia and you've suddenly seen your electricity prices go up, if you're worried about a new data center coming into your turf and you're worried about the water that might end up being given to you or not, if you're worried about generally the inflationary pressures of data centers,
or if you're seeing it, right? We had a story about people in Baltimore seeing their utility bills double or triple.
More than 1,000%.
Already.
Josh Saul has been on the back of this for us, really talking about how it's implicating people in the here and now. Microsoft's got the memo. They're doing a 5-point plan, how they're going to be good citizens. They're not going to be cutting out their property taxes. They're going to be thinking about water. They're going to be thinking about electricity. And Trump is also saying, look, this is an issue that is world. We want to own AI data centers. We want to win, but we want to also be able to make sure that you, the citizen, are paying the price. Interestingly, think about what Meta did yesterday. Meta Compute. This whole focus on Dean Powell McCormick coming on and being all in on sovereign and data center push. But this is really where companies are having to get a grapple with. They're all in on the AI infrastructure and the data center rollout. What does that mean for you and me and where the data centers go?
All right.
Yep.
Did you want to ask about
No,
the
I was just
You're
thinking
about your avatar.
No, well, I was also just thinking about the fact that like I'm from Virginia, right? And it's like the data center hub, and I'm from Northern Virginia, which is also like where all these big tech companies came in. But the governor of Virginia has been very clear in how he's pitched this. It's like, look at all these jobs we're bringing in. This is the new economy. He's not talking about electricity bills at all because maybe it behooves him not to. But for the most part, I feel like that's resonated with voters, this idea that like, it's not about electricity costs. It's going to be about jobs.
But how long do those jobs last? It takes quite a lot of people to build a data center. It doesn't take many to manage that data center.
Yeah, fair enough. All right, Caroline, thank you so much for joining us. That's Bloomberg Tech's Caroline Hyde.
I was still thinking about the cell phone question.
Okay, well,
you know,
our audience has no context.
Okay,
for the cell
because
phone question.
off air we've been talking about if you picked up all the people from the face of the earth and then you reset the earth to its prehistoric natural state, then drop the people down with nothing but their memories.
Yes, how long would it take you to invent the cell phone?
Right.
Well, mine's 1,000 years. If viewers want to write in what they think it would be.
I don't know. I'm thinking like 500 maybe, but
we would just need to survive first. We need to invent modern agriculture.
I think we would fight. We might stop teaching calculus. It's a question we'll work on. But I just wanted to share with the audience because I thought it.
I want to know what the audience thinks.
We'll ask Anastasia Amoroso. She joins us next. She believes the biggest risk to S&P growth this year is AI disappointment, and she joins us here on set. This is Bloomberg Open Interest.
what has continued to flummox us, just flat out, is that the market doesn't believe that there's genuine policy risk, right? If you look at risk premiums in this market, they're extraordinarily narrow. I think ultimately it's this idea that the investor class fundamentally believes that they have access to the debate and the dialogue in Washington and can ultimately put the brakes on.
Unfortunately, I think to the dismay of our producers, the debate we've been having on set during the break is the cell phone question. But that is a more important debate that Lisa Shallot's talking about. Speaking on surveillance, Morgan Stanley. Joining us around the desk is Anastasia Amoroso, Chief Investment Strategist for Private Wealth at Partners Group. Let's talk about the more important debate, Anastasia.
That was an interesting one.
Yes.
But yeah.
Thank you for humoring us. Okay, so a lot of policy coming from the White House. It's the midterms, it's busy, plus threats to Fed independence. Does it make sense that risks are at all-time highs? Should there be more policy risks, to Lisa's point, priced into markets?
I mean, unfortunately, or maybe fortunately for investors, we've gotten accustomed to this flurry of news that maybe flurry of threats, which may or may not end up being a reality. And so take Fed independence, for example. We've had those threats come and go throughout the course of last year, and yet we still can't say, I think, that the Fed is by and large independent. So just because there are policy risks, sometimes what investors see is we have a history of backtracking on those. And also there is a process. There is a court system. There are legal challenges. And more or less we go through the due process before there's some sort of a finite or conclusion. So that's why I think the markets have sort of been able to move forward despite the undercurrent of political risks and focus on what they know, which is we're at the start of the earnings season. We're expecting 8% earnings growth. We've got AI, which is driving productivity quite significantly so. And we have the midterms election year, which means, the policymakers are going to throw a lot at this economy in order to really kind of land that in a sweet spot.
To stay in their jobs. So you believe in the guardrails and you think elections will strengthen them. We're going to talk more about this with Anastasia Amoroso. She's sticking with us through the opening bell. This is Bloomberg. We are moments away from the start of trading as earnings season kicks off in earnest. This is Open Interest. I'm Matt Miller. Futures doing a whole lot of nothing here, really. At the index level, S&P futures, NASDAQ futures are basically unchanged. You do have a little bit of a rally in Russell 2000 in the small caps because the CPI inflation came in a little bit lighter than had been anticipated, and that bodes well for the potential of a rate cut. Obviously, the small caps benefit from that more than the big companies. You've got Pinnacle Financial ringing the opening bell. PNFP, the ticker there down at the NASDAQ and, down at the New York Stock Exchange. And at the NASDAQ, you've got TBBK, the Bank Corp, ringing the opening bell. This is, to be clear, not U.S. Bank Corp, the one that's buying BTIG. It's a different Bank Corp. Not very creative, these people, right? They were like, should we choose the same name that someone else has? And a dude was like, yeah. Why think of something different?
At least you know what they do. I mean, gosh, I hope they do banking. That'd
It's like
so
a
disappointing if they
fintech.
did.
It's a fintech.
Oh, it is?
Apparently, yes.
Okay, so even on that front, I was like kind of wrong.
It's not as famous as JPMorgan Chase. Let's put it
Shall
that
we
way.
look at what JPMorgan Chase is doing? Thank you, Matt, for that. Kicking off the earnings season, JPMorgan, it's been up, it's been down here at the open. It is unchanged, or I guess slightly up, about 0.1%. So it topped all of the estimates. A little bit weaker when it came to investment banking. They basically said deals are being pushed into 2026. They were very blunt on Trump's call for a 10% cap on rates. The CFO saying it would significantly change its business. It's bad for the economy. It's bad for consumers. It'd be bad for us. CEO Jamie Dimon, for the most part, gave an upbeat outlook on the U.S. economy, Matt.
All right, Delta earnings beat analyst estimates, but its annual profit outlook underwhelmed the street, as you can see by the reaction. The shares are down 2.5%. The airline also announced its first ever purchase of big, cushy, luxurious Boeing 787 Dreamliner jets, which is awesome if you're rich because you can fly on those in first class and it rules. But otherwise, it's not.
Does Delta still have a first class?
They do, but I wonder if they're lie flat seats.
People have been getting rid of it. That's not a ridiculous question.
I'm not bragging right now. Okay. But I'm flying first class to Detroit tomorrow night.
Wow, that is like high status.
I'm
Detroit
guessing,
first class.
I'm
the
guessing
life
there,
you live, Matt.
There won't be much of a difference between first class and business.
I say you're flying domestic first class, which is the same as domestic business. I don't think that you maybe sit like on the first row, and that's.
am in 1A. And,
you live,
and actually, I don't know if that's any better than 2A.
You live a lavish life, Matt.
Or 3A. It was the only seat left on the plane. Let's bring in Anastasia Amoroso, Chief Investment Strategist for Private Wealth at Partners Group. And Anastasia, so earnings season kicks off, and you expect 8% growth. And is that what you expect? Because companies always beat expectations. So is it really what you expect? Is that your whisper number?
No, that is not really what anybody expects, I would say. That's the consensus, but as we know, companies, 70 or 80% of companies have tended to beat those expectations.
They tend to beat like by 4 or 5%, according to DataTrack.
6 or 8, but probably, I would say all in, let's say we get 4 percentage points of upside to that 8% number. So probably we can get close to 12%. So that, what's really important is we've had a string of positive earnings quarters. And, as I mentioned, some of it is driven by the economy, but some of it is driven by productivity and margin expansion, believe it or not. So one thing that really caught my eye looking through the numbers for the earnings for the entire year is that consensus is expecting for margins to actually expand to 13.9%. Despite the tariffs that we've had to absorb, despite, perhaps some of the layoffs that are coming through. And I think a lot of that has to do with productivity. The fact that productivity rose close to 5% quarter over quarter annualized rate, and productivity sort of had this step level change in the last 3 years post the launch of ChatGPT. So that's important. If you can be more productive with the same amount of resources, if you can drive some cost savings, even if you can't quite drive the top line revenue with AI yet, the productivity certainly does add to those financial results. And I think that's what we are likely to see for earnings this quarter and this year.
For as well as equities have done, precious metals have done even better. I saw Kevin Gordon of Schwab put this out on X, that gold's on track to outperform the S&P 500 for the 6th consecutive month. The last time it did that was 2008 and 2009, which was a very different environment and lots of fears in that. Is there any signal in that gold and silver keep reaching new highs?
Yeah. I think equity investors have likely figured out that, it's not a good idea to stay away from equities because of geopolitical risks. And as I mentioned, this undercurrent of geopolitics and politics is always with us. Whether it's Venezuela, or Cuba, Greenland, or Ukraine, or, you name the number of geopolitical flashpoints, it's not a great idea to hedge that in equities. But it is likely a great idea to hedge that in precious metals. And I think that's why gold has been the go-to for that. And on top of that, we are shifting kind of to a new regime, I would say, from the monetary policy standpoint. You have the labor market in the U.S. that is clearly weakening. If you look at the 3-month average pace of job creation, it's negative 22,000. If you look at the CPI report that we just got, there are actually just very few categories that now have an inflation reading above 3%. So we're moving closer and closer to that 2% target. So all things equal, I do think that the Fed has scope to cut interest rates. So once again, kind of lower, real interest rates support also the outperformance of metals.
How, the president recently said he's going to put 25% tariffs on anyone doing business with Iran, which he's
another
probably,
geopolitical flashpoint.
But he's probably not going to, right? Because we've already agreed with China that we aren't going to put additional tariffs on them for a year. He said he wants to put a 10% cap on credit card balances, which, he's probably not going to do, right? Because obviously it would be horrible for the economy. He said he wants defense companies not to pay dividends or buybacks. Like all of these things he's coming out with that the market is just like, he's not going to do that. He's just saying it. How are you going to know if he ever says something that he actually is going to do that would tank the market?
I mean, that has been the whole week and a half of
How
this
can
year
you just
so
look
far,
through
trying
everything?
to parse through that.
Yeah.
But look, I think let's take some of those, one by one. First of all, the credit card cap, that is not something that a president can do single-handedly. That is something that does likely require an act of Congress. And there are a couple
so
of
would
bills.
Tariffs normally, right? But he uses IEPA for tariffs.
Right. We'll find out what the decision there is. But for credit card caps in particular, there are a couple of bills that are pending in Congress, and maybe there's some chance of them passing, but I think that chance is likely minimal. When you think about, tariffs, to your point, until we hear otherwise from the Supreme Court, the executive power has been something he's been able to use to, force the policy action. And I think there is a pretty significant game plan, an action plan, and it is all geared to, kind of shore up consumer confidence in a midterm elections year. And let's talk about gasoline prices, for example. Venezuela, as you know, largest oil reserves. And what's really important is that the type of oil that Venezuela has, the heavy crude, that is exactly what the U.S. Gulf Coast refineries were geared to refine. And so what a great move to potentially displace the Canada heavy crude, which is what's currently been routed to those refineries, with Venezuela heavy crude, which happens to have a lower break-even rate.
Except for we can get the heavy crude that Canada has access to out of the ground, unlike the heavy crude in Venezuela, which we cannot get out of the ground.
Well, that is the hope, that 1 million barrels a day goes to something higher, to 1.5, 1.6 in a period of time. But that does move the needle, and I think that's why the gasoline prices in the U.S. have already responded to that. So, Matt, I agree with you that you can't look at every single one of the headlines and say this is certainly going to be what the outcome is, but you should parse through some of them and sort of just perhaps have two different piles. This is going to happen. This is likely not.
What a start to the year. Anastasia, thank you so much
been eventful.
for joining us. Anastasia Amoroso. Okay, let's get a check on where the stock market stands right now, because we are putting in some slight gains, somewhat helped this morning by softer CPI, although, okay, we're unchanged, so maybe I kind of exaggerated a little bit. Unchanged, though. 0.03% higher is still at a record. Alphabet continues to lead the pack. It is now worth more than $4 trillion. It surpassed that level, also surpassing Apple, which is having a pretty good day, too. On the other side of things, the credit card companies still struggling. Visa down another 3%. Microsoft slightly weaker, only down 0.5%. But MasterCard, JPMorgan now slips into the red after opening initially higher with a set of really robust results. A slight miss on investment banking. The bar was extremely high considering JPMorgan's trading around some of its record valuations. When it comes to the sectors, energy doing really well this morning. That's up 0.9%. And in the down pile, likely dragged down by those card companies in JPMorgan, that's down 0.8%. More bank earnings to come. We are going to be getting Wells Fargo, Bank of America, and Citi tomorrow. So we'll see how that changes the mix and the fortunes of financial companies, Matt.
Yeah, we're going to hear a lot more about that over the next couple of days, and it's pretty exciting, darn it. I'm really looking forward to...
And maybe more M&A. That also is impacting financials. The U.S. Bancorp deal with BTIG.
Yeah, maybe more M&A, or maybe other banks are going to have the same advisory shortfall in terms of revenue growth that happened at JPMorgan. JPMorgan has warned that a cap on credit card fees could really upend its business model and, no big deal, the U.S. economy. Details next with our Bloomberg intelligence analyst. This is Bloomberg Open Interest.
Let's take a look at the top calls, the upgrades and downgrades from sell-side analysts. First up, KeyBank, they upgrade Intel and AMD, both rallying this morning, saying that demand for server chips is so strong that both companies are sold out through 2026. They see big cloud customers driving the surge, with Intel showing clear improvement in chip production. And then when it comes to AMD, they will benefit from fast-growing AI demand that could give it room to raise prices. Next up, Wells Fargo, they downgrade Charter to a sell and slashes price target on the company. The firm says that fiber and fixed wireless are steady, taking share from cable, pressuring Charter subscriber growth and cash flow outlook. Those shares down nearly 2%. Finally, Jefferies, they downgrade Live Nation. Jefferies says that demand trends are cooling after a strong post-pandemic run and expectations are getting harder to meet. Jefferies also adds that regulatory uncertainty is weighing on visibility and confidence. Those shares down 2.33%, Matt.
All right, we'll be watching very closely Jefferies and the other financials over the next few days, because earnings season is kicked off with the big one, JPMorgan kicking it off, beating on most measures. The CEO, Jamie Dimon, gave an upbeat outlook on the U.S. economy and weighed in on Fed independence, writing, "I do have enormous respect for Jay Powell. Everyone we know believes in Fed independence. Anything that chips away at that, probably not a great idea." And it seems like he's being a bit understated there. Herman Chan, senior U.S. bank analyst for Bloomberg Intelligence, joins us with more. And I won't ask you to weigh in on, Fed independence.
Sure.
But rather on the earnings. I thought trading was expected to be a little bit softer in Q4, and yet they beat.
Yeah, they beat. Expectations coming into the quarter was about 13% growth year over year. They cleared that by about 17, 18%. So that's great to see. On the other hand, investment banking was a little bit softer, but still expectations are for 2026 to be a banner year.
Seems massively softer, right? Underwriting revenue was down 2%, and the street was looking for a gain of 19%.
On the investment banking side, it was a bit single-digit growth. So, and they came down a bit lighter. So, fourth quarter is typically a bit more seasonal in nature. So that had something to do with it. But still expecting strong activity, given just IPO calendar and the like. So strong investment banking results expected for 2026.
And Herman, you and I were both on surveillance as that media call was undergoing, and the CFO was talking about the credit card business. I'd say he was so blunt, actually kind of refreshingly so.
Yeah, sure.
I mean, he didn't say what the hit to the business would be, but I mean, it would be bad. He was like, we would significantly change our business. It'd be bad for the economy. It would be bad for consumers.
Right.
What would it mean for the overall beast of JPMorgan to have to significantly curtail their credit card business if you did get this 10%?
Yeah, it would be a massive rewiring of what they do, how the business operates, how they underwrite risk. You could see a big swath of consumers just have their credit card shut off if this would happen. So, credit lubricates the economy. So it has really drastic implications for GDP growth if the credit card cap does get enacted.
In terms of on the investment banking side, the M&A advisory revenue that fell short, is it just being pushed into Q1? So are we going to see a banner quarter in Q1 for the same numbers?
Yeah, that's right. So a lot of it was pushed out. This is not activity that just goes away. So we had some slowdown in the activity just because of how the calendar ended. Typical fourth quarter seasonality, if that gets pushed on the first quarter, we should have really strong results on the banking side next quarter in Q1.
And I'm also guessing that like all these banks are trying to position themselves for these monster IPOs we're going to get. Like if we have SpaceX, is this good for everybody? Is it going to be a fight tooth and nail of who actually gets to take hold of these IPOs?
Yeah, it's going to be tooth and nail. You want to be the lead book runner on these deals. So technology is something that we expect to be really a big driver for IPO activity for next year. And JPMorgan, Morgan Stanley have really strong tech practices, so we'd expect them to do well.
Right, Herman, thank you so much for helping us cover that. Herman Chan of Bloomberg Intelligence. More bank earnings to come, and we'll get more thoughts from Herman. Some breaking news, by the way. Bloomberg sources saying that Meta wants to double production for their AI-powered smart glasses, those Ray-Bans, by the end of the year. It's not impacting shares at all, but it is remarkable for them to say that demand has been surging. We need to increase annual capacity. Originally, these kinds of smart glasses were like a boondoggle for like the Google glasses and all these, but
even for the first look, I've been searching for these glasses. Right, they're only available in limited color supplies, and every time you look for the new Meta glasses, you come upon on the internet an ad for the old ones at a discount. But they don't have the new ones, so it makes sense. Everybody wants Gen 2. Nobody wants Gen 1. They're giving those away, and they need to make more of these.
Pretty remarkable. And we are going to talk more about big tech, about this story, and what's happening with Microsoft. Trump wants big tech to foot the energy bill for data centers. Companies are listening. All of that coming up next.
This is Bloomberg Open Interest. I'm Matt Miller. Quick check on what's going on with stocks. You can see not a lot of movement on the index level. So the S&P 500, the cash trade down 0.1%, but still at a very high level. The stock market, it's safe to say, has done incredibly well. Compound gain of 80% over the last 3 years to 69.70. I'm going to sneeze. No, I didn't see it.
Always happens that way.
NASDAQ unchanged at 25,787. Look at NVIDIA, down 0.5%, always highlighted right here in that corner so we can see, because it's such a heavy stock, what it does. By the way, we're looking at a number of milestones over the past couple of days. Google is now worth more than $4 trillion. We're watching for Walmart to get to $1 trillion, and we'll update you when that happens in terms of market cap. Intel right now up 5.5%. How long would it take humankind to make a chip if we reverted back to nothing but still kept our memory? That's the question we're debating today. JPMorgan Chase after earnings down 2.5%, and Delta Airlines also down 2.5%. Interesting because both kind of beat, but the numbers at Delta really underwhelmed the street, and JPMorgan actually missed on investment banking advisory. Meta, we're going to talk about right now because they come out with new glasses, or the same glasses, but they're going to boost production. We're going to talk to Ed Ludlow about that. And then Microsoft saying it's going to try and pick up the tab for the extra cost it's putting on consumers in terms of electricity because demand is so high for data center use.
Let's start on that Meta story. Again, Meta wanting to double production of the Ray-Ban glasses, the smart glasses, because of huge demand. Bloomberg Tech's Ed Ludlow joins us from San Francisco. Ed, I'd imagine you were also at CES. I know you were at CES, but I'd imagine you saw their new Ray-Bans too, and the demand there. They're shipping less abroad because everybody is buying them here. I mean, Ed, how did these things end up being such a big success when past attempts to make smart glasses just largely fell flat?
Yeah, the Meta Ray-Bans have been even a surprise to the leadership at Meta. They never really thought that they would have the traction that they have. So the installed capacity on an annual basis that the EssilorLuxottica currently has is 10 million. And sources are telling us that Meta wants them to double that to 20 million. But actually, the demand is strong right now such that if they can see the demand being sustained, what we're hearing is that for 2026, maybe even 30 million units. And, you know, I know you guys were talking earlier in the program about the cuts to the Metaverse initiative. But the reason this has been a success is for Meta, the glasses have been the form factor by which consumers engage with Meta AI, a voice-based AI assistant. It's not so much the novelty of the front-facing camera or the ability to listen to audio. It's the ability to use the AI in that medium. And the next evolution of that being, of course, putting a display into the glasses, moving it into the augmented reality space.
I do wish they could shoot horizontal video, Ed, because they only now shoot vertical. Like I'm a tween on Instagram, right? I want to shoot something in landscape. But I want to move on to the job cuts story. They're going to be cutting 1,000 jobs from kind of the metaverse division. That didn't really pan out. No one's really living in the metaverse. Are they going to be able to move those people, I wonder, over to the AI division where they're investing so many dozens of billions of dollars?
This is also not a new story, right? Meta has been shifting its commitment to literally compute capacity of a data center, and then on the talent side, the software focus of AI, both for internal use and external use for quite some time. The issue with the metaverse, and by metaverse we talk about a virtual world which you interact with through the VR AR headset, different to the Meta Ray-Bans, is that unit, Facebook Reality Labs, was loss-making in the billions of dollars and continued to be. You know, the go-to-market of the headset and the digital services that came from it did not get the traction that the AI-driven Meta Ray-Ban glasses did. So it's not new. But again, like 1,000 to 1,500 is 10% of a much larger workforce. And as Kurt Wagner reported before the holidays, at one time they were considering cutting 3 times that. It's very normal for Meta to manage allocation of resources like this, and headcount is a mechanism that they use.
Ed, I mean, just very quickly, we got like 30 seconds here, but I'd imagine if you're Apple, you're like, man, we almost had it. We almost had it right, but we shouldn't have had a headset. We should have had glasses.
Yeah, again, it's how is the consumer or everyday person going to interact with a voice-based AI assistant? People spend a lot of time on the smartphone. Humane Pin is a great example of an abject failure. It just so happens that the glasses have traction, and that was on display at CES. There are now many more smart glass offerings.
All right, Ed Ludlow, looking forward to your program at 11 o'clock. We'll be back with Stephanie Gill. This is Bloomberg. We are 30 minutes into the trading day as earnings season kicks off in earnest. Welcome to Bloomberg Open Interest. I'm Matt Miller.
And I'm Dani Berger. You might have Delta falling. JPMorgan goes back and forth. Neither of those really moving the needle. It is a market that is little change this morning, down 0.1%. But we are just sitting at all-time highs. So unchanged would help us there. And Matt, some breaking economic news.
We're looking at new home sales crossing the terminal right now, and we have Michael McKee here with us, our international economics and policy correspondent, to break the data. So we're looking at a couple pieces of data, Mike. One of them looks fairly in line with expectations, and the other one wildly different.
Well, the problem is this is another one of those distorted economic data points because of the government shutdown. This is both September and October new home sales. The October number comes in at 737,000. You can see there's no prior number because there is no prior report for that yet. New home sales on a month-over-month basis, on a percentage basis, were down 0.1%. The expectation was they'd be down 10.6%. So a little bit better performance. But of course, the new home sales market is still an issue for the overall economy. The seasonally adjusted change in the number of new houses for sale at the end of October 2025 was 488,000. That's just about the same number as in September, but we didn't have a number for September until today. So there's not adding a significant number of houses out there, although there's still a 7.9 months inventory out there, essentially unchanged from September, but it's below the October estimate. So still not building enough houses. Median sales price, $392,300, 3.3% below September. But so maybe that played a role a little bit in getting a few more houses sold. But the new home industry still is a laggard out there for the overall economy.
We've had a lot of data, and Mike, I was just thinking when you're talking about, do we have the past month to compare it to? Non-farm payroll, CPI, new home sales, everything that we've gotten from official government data. Has the fog lifted? Is this enough for central bankers to have a more clear idea of what they're going to do this month and months to come this year?
Well, if you leave your house at 7 a.m. and everything's foggy and you can't see it, maybe we're at 8 a.m. now and it's starting to lift a little bit. It's not completely there. We're going to have distortions in the data for quite a while. We're going to have distortions in the CPI until April because of the way it's constructed and the numbers that are missing fall out. But we're going to see slowly, gradually improving data because, of course, we now have the September, October numbers. When we do get the November numbers and December numbers for new home sales, they will be give us more of a comparison, put it that way. But they're still running behind on collating and distributing all this stuff.
All right, Mike McKee, thanks very much for bringing us this data, our international policy and economics correspondent, talking about new home sales, which is so important. Certainly to this administration, to this economy. Obviously, housing is key to continued growth, and it has been in somewhat of a slowdown. Joining us now is Stephanie Guild, Robinhood Chief Investment Officer. And Stephanie, what do you think about how this economy is going with all the levers the administration is pulling on housing? It looks like they actually have gotten mortgage rates to come down pretty significantly. How closely do you watch that?
We watch, the 10-year is very important for the markets as well. And that's really what drives mortgage rates, right? It's not necessarily what the Fed is doing. And historically, the Fed taking down rates has impacted the long end of the curve simply because most of the time we'd been in a recession. And the Fed taking down rates because inflation is cooled is a very different story. And I really keep coming back to the deficit, and it doesn't look like we're really chopping it down at all. And that really is going to keep, to me, the 10-year.
The deficit, like the national deficit?
The national deficit.
That doesn't go down.
But that's what I mean. The fact that there's going to have to be continued supply is going to put a floor on rates, in my opinion. And that's going to put a floor on mortgage rates unless there's something else that can be done.
Right, and it just gets worse with the president's proposal, whether it be one big, beautiful bill, the checks being handed out, especially if he gives $10,000 to every citizen in Greenland. Why doesn't the market care, though, Stephanie? Because it is clear what some of the impact would be on the deficit, and yet here we are in a very tight range for this bond market.
I think because you are also seeing true facets of GDP growth. I did a deep dive in my outlook on the Tax Act of 1986 and how you can see such a line in the GDP numbers between before and after that. It was meant to simplify taxes, but it actually cut off a lot of incentives at the time on building and infrastructure development. And I actually think that is one thing that the One Big Beautiful Bill is going to do, and the increased spending on defense is going to create some GDP growth. And I think that is a little bit of a counter to what we see in the deficit.
What are your investors watching, and what are they doing other than buying stocks? Because certainly the market has just gone up and to the right. Okay, we've been a little bit range bound lately, but we still hit incremental new all-time highs.
Yeah.
Most days, right? At
They're still buying
69.70. Yeah.
Yeah, I mean, they're still buying stocks. Like, we've definitely seen an increase in ETF activity, I would say. I've seen more some of the levered plays being sold because I think it's worked. But now you're seeing, like, it is a stock picker's market, by the way. Like, that's something strongly believed too. With higher interest rate levels, it just creates differentiation among companies. And our customers play that. So recently they've been buying more of, like, the AMDs and NVIDIAs of the world and selling, like, Amazon and some of those levered tech plays.
Are your clients doing better picking stocks than just buying VUs and holding that? I mean,
yeah, I mean,
better than 80% over 3 years, because that's pretty good.
I mean, at least this past year, they did pretty well, I would say. And because I think there was so much skepticism still in the market, and our clients did not have that. They were absolutely investing in some of the riskier plays that ended up working. I think Q4, like, at least December was a little bit rougher, but otherwise, I mean, you've seen it even, like, they've been participating in the silver trade through ETFs.
Yeah, I mean, again, the metals have done so extremely well. Torsten Slok from Apollo had a note out today just saying that the S&P 500 is extremely concentrated in AI. I don't think that's revolutionary to anyone. But if you have the scenario where the market itself has a lot of concentration in AI, plus people are buying AMD, NVIDIA, is there just a general overexposure from a lot of the clients that you're seeing? And is that a dangerous thing, or is that, like, the trade so great, load up the boat on it?
I would say people do have a tendency to be biased towards momentum. And, it does work. At least it has worked more often than it hasn't. But I'd say below the surface, like, below the top 10, you definitely see them playing some of the other trades that aren't working all of the time. And you might see it in, like, the quantum stocks, like, they're up and down, right? And they'll have big news and then it will sell off. So I don't know. I don't think that's revolutionary, but I actually don't think that's where the biggest
By the way,
gains are going to be.
For some of these, like, the really volatile, because I was just thinking of the quantum stocks, a great example of that would be, like, credit card companies when they sell off. Are investors willing to buy the dip when it comes to policy-driven sell-offs?
Yes, I think so. I mean, you kind of saw it all over Twitter this past weekend. Like, they were like, oh, I can't wait to buy MasterCard and Visa because they think this affects that. People will think this affects them when it doesn't. Well, I actually think it does, because it will impact activity and it will actually reduce the amount of credit available to people. So I don't think it's a great idea. But there is something to say to the average consumer of such high interest rates, right? Like, there is something to say for that. But
the president wants... On the Fed, the president wants them to cut rates because he's trying to unlock the housing market, because he wants to lower the cost of financing a car purchase, for example. But are rate cuts necessary to further drive gains in the stock market? Do you think that the Fed needs to cut rates for the S&P to go higher?
No. I think you just need to see... Actually, I think the S&P isn't necessarily going to be the center of the universe because of the concentration that we talked about. But I actually think that a lot of the other policies put in place are going to drive higher movement in stocks below the surface. And so we took down our earnings expectations in coming up with our target for the year in the tech sector, because it was like 27%. And I just think a lot of good news is already baked into that. And it doesn't mean that it can't reach that, but if you already think it's going to happen, then it means that you set a higher and higher bar, whereas there's a lot of really good stories below the surface that have recovery plays. And I actually think the first half of this year is going to be all about keeping the customer happy, like keeping people engaged and wanting to keep the administration bias towards the Republican side.
By the way, what's just quickly like one of those underappreciated things that you think is going to have a great year?
Well, we started investing in things like Lululemon and On Holding because they had negative returns in 2025, and they have been recovering since. Because I think there's a micro story there too. Like it's not just about the consumer. It's not just about where interest rates are, but like the companies lost their way, and well, On didn't, but Lululemon lost their way, and now they're kind of coming back, and they'll have a new CEO in place, and I just like stories like that.
Stephanie, so great to have you on. Thank you for joining us.
Thank
Stephanie
you.
Guild of Robinhood. About 40 minutes in your trading day. A quick look on markets. They are down this morning about 0.25%. Tech does a little bit better. It's down 0.1%, despite the fact we had softer CPI. That's not really helping us. Either crude is near a high this morning, up 2.7% after the president putting on Truth Social that he was canceling all meetings with any Iranian envoys. That is the state of play in these markets. What about some of those individual movers, Matt?
Let's take a look at some of the single stock stories here. Shares of Intel and AMD are both rising following upgrades from analysts at KeyBank. The analysts there citing strong server CPU demand. Well, there's strong demand for server CPUs?
Who would have thought? Well, apparently some people didn't know because they're surging. Delta reporting better than expected fourth quarter earnings. They delivered a disappointing full year 2026 profit forecast, though, so shares fall.
And JPMorgan kicking off big bank earnings, beating on most measures, though not investment banking advisory fees. The CEO, Jamie Dimon, gave a largely upbeat macro outlook, and he continues to be the master of the universe.
Yeah, he's on the call right now talking about an increase in expenses and spending to keep up with his competitors.
I saw that.
And he said, we're going to stay out front, so help us God.
I think what they're going to costs are going to be $105 billion this year, according to Marianne Lake. So maybe that's one of the reasons that you see the stock down, other than the M&A miss, but that should be made up this quarter.
Yeah, it's a good point. We're going to talk more about those earnings. We'll speak with Jason Goldberg of Barclays on the JPMorgan set of results. Stay with us on Open Interest.
Let's get out of high interest. Look what's making headlines around the world. President Trump has canceled meetings with Iranian officials, escalating pressure on Tehran as deadly protests continue. Human rights groups say at least 600 people are now confirmed dead and warn Iran may carry out mass executions. Despite a crackdown and an internet blackout, videos show fresh protests are still flaring in the region. The president also said he would impose a 25% tariff on goods from countries that do business with Iran. And two of the biggest trading partners are China and the United Arab Emirates. In other news, the FDA says popular weight loss drugs like Wegovy and Zepbound do not raise the risk of suicidal thoughts or behavior. After reviewing data from 91 clinical trials, the agency asked drug makers to remove suicide warnings from the labels. The decision clears up lingering safety concerns, some of the lingering safety concerns around GLP weight loss medicines. I'm sure there are others. JPMorgan CEO Jamie Dimon is warning that Justice Department pressure on the Federal Reserve could undermine its independence and ultimately push borrowing costs higher. In a media call, he said, quote, "I do have enormous respect for Jay Powell. Everyone we know believes in Fed independence. Anything that chips away at that is probably not a great idea." Those comments come as JPMorgan reports mixed fourth quarter results. Investment banking fees missed guidance, but trading revenue beat expectations, and the bank projected stronger net interest income. Dani?
Let's get more on those results. And joining us now is Jason Goldberg, a senior bank analyst at Barclays, who has an overweight rating on JPMorgan. Jason, Jamie Dimon saying the U.S. economy is resilient, business is healthy. What was your takeaway?
Yeah, no, we thought the quarter was solid. You saw, growth in loans and deposits, net interest margin expanded. Costs were controlled, and credit quality really benign. So I think everything in the quarter kind of points to continued economic expansion. And after a couple years of good results, that should persist into 2026.
Are costs a concern at all, Jason? I noticed Marianne Lake disclosed numbers that were a little bit higher than the street maybe anticipated.
Yeah, no, last December they signaled, expenses for 2026 would be $105 billion, and today they reiterated that. I think at the time, last month, the numbers did catch people maybe a little bit off guard. But keep in mind, a portion of that is to just help fund better than expected revenues. So those are quote unquote good expenses. And then a piece of it is to just kind of continue to stretch its lead, both in kind of building new branches as well as technology investments. So while a big number, it's a number it should get an ample return on.
Right. Those technology investments specifically, Jason, because if you look at the head counts, a little bit higher for JPMorgan, but more or less flat. Cities aiming to let go of 1,000 people in the next week. Are we about to witness a big productivity boom for these investment banks, for these big banks, Jason? Is there need for employees, especially in back office, about to lessen to a really large extent?
There's definitely a need for employees, but there's no reason why these banks can't be more efficient. So we look at measures like, revenue per head count, for example, that's steadily increasing, but there's no reason why you can't see an acceleration of that as banks look to use leverage technology and AI to better automate processes and procedures, to reduce fraud, and ultimately to help drive additional revenue.
Is there any concern about loan loss provisions? I think they may be creeping higher, and I saw that they already put on loan loss provisions for the Apple credit card business, even though they don't take that over for a couple of years here. I wonder, because he's upbeat, Jamie is on the economy. What's the concern about not getting back the money they loan out?
Yeah, no. Credit quality is really, really benign. And in fact, if you exclude, the purchase of the Apple card portfolio, where just in the accounting you have to book the provision up front, even before you buy the loans, they actually released a little bit of loan loss reserves. Their non-performing assets declined. Their net charge-offs declined. And if you look at their credit card net charge-off forecast for 2026, it's only slightly above, 2025, despite the fact they've actually grown that book at an above-average clip the last few years. So, by all indications, obviously we're only 1 to 2 banks into the earnings season, but credit quality very stable.
Jason, I was listening to the media call, and unsurprisingly, the first question they got was about the president's proposal, desire, order, call it what you will, to cap credit card interest rates at 10%. The CFO, Jeremy Barnum, took that question saying, we're not going to quantify it because there are so many uncertainties there, but for an avoidance of a doubt, if it were to happen, it'd be bad for consumers, bad for the economy, bad for us. Jason, can you quantify the impact that this might have?
Yeah, so there's the first order impact of, you can't raise, your APRs over 10%. And, banks would react to that, whether it's reducing rewards, increasing annual fees. But, the thing they would most likely do is just restrict access to lower end consumers because they can't get compensated for that. And I think if that occurs, that's a much bigger impact than kind of the profitability of a product, because that has the potential to adversely impact the economy. And, a lot of different industries, in particular, whether it's retail or travel and the like. And so there's much, much more broader macro implications that I think needs to be considered than just the P&L impact of not being able to have, APRs at an appropriate level.
Jason, the shares, I always look at a 5-year snapshot just because the Bloomberg comp screen defaults to that, and I think it's a fair performance window. They've done better than Citi and Bank America, but not as well as Morgan Stanley, not nearly as well as Wells Fargo and Goldman Sachs. Does that make sense to you in terms of the performance when you look at all the big banks?
Yeah, right. And sometimes it depends when you pick your starting point, right? Like,
yes.
Wells kind of that cap sell off and bounce. But listen, on average over time, they've been a superior, performer. I think the shares were up 35% or so in 2024. They're up 40% plus in 2025 as they kind of continue to take share across every business they choose to compete in. At the same time, putting up 20% plus return on tangible common equities, which is well ahead of peers. Looking out, we expect those tenets to continue and the shares to continue to outperform.
Yeah, I mean, you are speaking to a high bar, which is maybe part of the reason shares are dropping around 3% this morning, Jason. Some people have also pointed to their investment banking underwriting fee miss. JPMorgan, for their part, said it was because a lot of deals were being extended. They're being pushed out into 2026. Jason, is it a concern for you that they missed on investment banking fees?
Not at all. You did have the government shut down for part of the quarter, and that did delay some issuance. predicting if an M&A deal is going to close on D31 or Jan 1, is sometimes tough to predict. But by all indications, the outlook for both kind of corporate M&A activity, really across all industries, as well as fairly large IPOs, remains quite robust.
Jason, though, if I can just jump in, because so you get a delay initially last year because of Liberation Day. You get a little bit of softness and delays at the end of the fourth quarter because of a government shutdown. These are all policy-driven things. Very quickly here, Jason, like 30 seconds. I mean, that's not going away. There's still so much uncertainty. Who's to say it won't be delayed even more until 2027?
Yeah, it's certainly a risk, and the offset to that is that uncertainty is kind of aiding your trading businesses. But there is a definite desire by corporates, really across all industries, to achieve economies of scale, invest in technology, and consolidate. So I do think you'll see robust M&A activity in 2026. There's a lot of companies that express their desire to go public. I think you'll see that over the next several months. And at the same time, sponsors and private equity, which haven't really participated as much, are starting to come off the sidelines and be more engaged. So we do think while 2025 was a good year, despite Liberation Day and the government shutdown, we think 2026 will be even better.
Jason, great getting your intel. Really appreciate your view. Jason Goldberg there of Barclays. This is Bloomberg. Let's get a look at what's going on in markets. Just about an hour into the session here, you can see that we are slipping a bit with the S&P falling 0.4%, still at 6950. The Nasdaq right now off also about 0.4%, while the 10-year yield comes back off. It was up to 420 almost yesterday. Now it's trading at 417. And you do see oil rising as well. NYMEX crude up to 61.23. Coming up, as the Trump administration pushes to lower housing costs, Americans are fixing up instead. We'll talk to Ace. The home services sector is booming, already worth nearly $700 billion and on track to top $1.4 trillion by the end of the decade. As the Trump administration ramps up efforts to lower housing costs, high prices are still pushing many buyers towards fixer-uppers, while an aging population is driving demand for home modifications. For more on how homeowners are renovating and spending, we're joined by Andy Bell, the CEO of Ace Handyman Services. And Andy, my first question isn't necessarily about the gear that you're selling, but about the people that use those tools. Are there enough handymen out there? Because I have a really difficult time finding someone capable of dealing with HVAC and plumbing and electric, etc.
Good morning, Matt. Yeah, we're excited to be here. And yes, labor is one of the most critical functions in growing any of the home services businesses. We consider it if we don't spend all our time hiring, training, and evaluating, we'll spend all our time hiring, training, and evaluating. It is something that organizations such as ours, we've put apprentice programs together where we can take somebody from an apprentice to a handyman to a craftsman, all the way to franchise ownership. So this is something you have to focus on every day. And I'm very hopeful that the industry is starting to see people celebrate those going into the trades, not ending up with a lot of debt, and really finding tremendous satisfaction in the home improvement lane. I'm hopeful, but it is an anchor on all home services that we have to drag behind us.
What is labor the biggest constraint, Andy, when it comes to home services and home improvement? Or is it costs? Is it ability to obtain materials? What tends to be the biggest roadblock for getting some of these projects done?
Yeah, the biggest roadblock is labor. You have to be an employer of choice. You have to treat people with dignity and respect, and you have to honor their work-life balance. And companies that are embracing that are continuing to indeed grow in this, resilient and strong market. What we've grown in and continue to do competitively, we've found our footprint is coast to coast. We have 400 locations. We operate in 47 different states, and each of these states, we're able to find expert craftsmen that are multi-skilled, and they really love being employees of the organization and knowing that we have a one-year guarantee on all labor, all materials. It's creating a comfort for both the staff that we employ, the expert craftsmen, and the people that work in the office. That's what we've grown on. Ace Handyman started as Handyman Matters in the basement of my house. It's going to be 29 years ago next month. And as we grew, we realized in 2019, coming under the umbrella of Ace, that really national brand locked in the trust, and we brought the reliability and professionalism to the industry. So people come to us because it's a fun, interesting, and challenging position. I believe the trades are on the upswing, and the youth are starting to, be exposed to this industry. You see it a lot. There's a lot of people who have, as first-time home buyers, haven't got access to that kind of stay-put stock, the houses where somebody traditionally would have left and moved to a downsized equation. The high interest rates, the high the high interest rates and the high housing prices have created this stay put economy, and first time home buyers are going into houses that need a little more TLC than they probably planned on, and they're finding interest and passion in the home improvement industry. So I'm hopeful that this is all going to grow in the direction it is, because it's a competitive, solid, regular demand market.
Andy, both Dani and I love the Ace hardware stores. I go to the one in Bronxville all the time. I'm guessing she knows the
On West
store
4th.
On West 4th Street,
Yep.
So there's one in Manhattan, obviously, as well. How does your business, which helps homeowners get access to all the services they need, work together with what seems like a mom and pop shop on the corner, the Ace Hardware in every small town, and apparently in the largest city in America as well? How do you work together?
Well, we all love Ace Hardware from the foundation. It tends to be a 102-year-old brand that's celebrated in any market. And so when we go to do a home project, the first thing we do is we check the availability of product in the Ace Hardware stores. So we're bringing helpful to people's homes through Ace Hardware. You go in Ace Hardware, you buy the materials that you need, but it's really a transition in the market where people want us to do it for them. And in that do it for them market, they also want us to buy the materials. And our first preference is always going to Ace Hardware.
Andy, I would love, before we let you go, just to get a very big picture general sense. This is a moment in policy where at least the president and his party is trying to do a really big push on affordability. What is the sentiment out there among Ace Handyman Services customers? Is there a willingness to spend, to take on big projects? Is there some conservatism? What are you seeing?
We're seeing, people staying in those really easy to fix, to remodel homes. There's cosmetic. The homes that people are staying in longer, they need carpet and paint, just simple stuff. What we're seeing is the new home buyers being pushed into more fix and flip markets. And they're using technology to contact home services. They're challenging us to make it easier to communicate with. And what we're seeing is a tremendous demand right now for projects. We used to be, I think we sit at the intersection of necessity and trust. And that larger brand that we have nationwide, the resilience of our local operators and our local experts in each of these markets has created a demand because it's easy to use. So we see people that are first-time home buyers going on for a long time, and the trade, we aren't reversing the aging in this country. So people, I think the latest statistic is 75% of people that are over 50 want to stay in their home permanently and age in place. So that brings on a whole nother level of project and demand. We see favorability in this fragmented market from being a national brand with local roots that stand in there, and the significance of this industry towards the consumer purchasing market. I think it's a behavior change, and people are using these as a line item on their budget. Repair and maintenance used to be, you'd see a handyman every now and again. Now you're starting to see people using us on a more regular basis. So I see favorability in this market for a long time to come.
Andy, thanks for joining us this morning. We appreciate your time. Andy Bell of Ace Handyman Services. Coming up on the show, turning chaos into cash. The $5 trillion hedge fund industry posting its best year since 2009. We'll get the details coming up next. Stay with us on Bloomberg. Hedge fund investors haven't had it this good since the aftermath of the financial crisis. Data compiled by industry tracker Hedge Fund Research shows that in 2025, the industry had its best year since 2009 with a gain of about 12.6%. Bloomberg hedge fund reporter Hema Parmar joins us now for more. And I know you've been looking at this, some of the individual returns too. What was the thing that fueled this industry for such a good year?
So there were many things all coming together. You're looking at just a really volatile market, the good kind of volatility, where there's a lot of unpredictability in this space. You don't know what's happening around AI technology. You have geopolitical tensions. You have wars in the Middle East. You have interest rate uncertainty. So all of these things create these ebbs and flows in the market that provide trading opportunity for funds to wager around. And so as you've seen, a lot of funds made a lot of money. We have pretty much steady gains across all strategies, across all sizes. And so it's been one of the best years to be a hedge fund trader.
Is it, I was reading about the returns earlier, and there was a lot of excitement around double-digit returns.
Yeah.
But the S&P also made double-digit returns. It was, the benchmark index was up 17%.
Yes.
Is it necessarily then easier for these women and men hedge funds to make good returns when the overall market is up as well, or does that not correlate?
So sometimes the lifting tide raises all boats, but when you look at hedge funds, they really should be making alpha, which is beating the markets in some ways, depending on the strategy. But really, it's creating
and that's important, by the way, Hema, because they're not all benchmarked to the S&P,
not all,
right?
Exactly. So you really
may have a strategy that was only up 5%, or you may have a strategy that was down.
Exactly. So it really depends on the strategy. And does the strategy benchmark themselves against which indices? So when you look at that, that's important. You also want to look at how people use hedge funds. And they use them oftentimes to hedge against a down market, to hedge against when things are not doing well, to diversify your portfolio so you don't have just long stock exposure. So again, that's why strategies matter. Are you in a long tech hedge fund where you do sort of look at the S&P maybe a little bit more closely and where maybe the tech AI positions track it more? Or are you looking at some sort of more nuanced credit hedge fund that's doing things that are different, where if there is a down market, the fund should protect against that and make you money so that your portfolio is a little bit safer.
Does it help them that when you look at other things one might compare hedge funds to, in the alts bucket, that private equity hasn't done as well, that they've been struggling to exit, that they're not giving money back? Does that also give this industry a lift?
It does, because in some ways you are seeing flows move back into hedge funds with concerns over private equity. But on the other hand, the biggest allocators are still stuck in private equity. And so what that means is they don't have as many dollars to put to work in hedge funds as they did before, when they would get these distributions from private equity that they could then reinvest into different things. So in some ways, it's harder, because if you are a fund manager out there raising money, you're looking to retail investors. Maybe you're looking to Middle East sovereigns to raise additional cash, rather than the traditional pensions, endowments, foundations, where it's a lot harder than it would have been otherwise.
All right, great story, Hema. I recommend everyone go to the Bloomberg terminal or Bloomberg.com to read it. Hema Parmar wrote about hedge funds turning chaos into cash for the best gains in 16 years. So they have done well, to say the least. Now, with his directive ordering Fannie and Freddie to buy $200 billion of mortgage-backed securities, President Trump has opened a new front in the administration's effort to bolster housing affordability. But Rebecca Patterson of the Council on Foreign Relations said Trump needs to consider the ripple effects.
I think the president and the administration need to be careful. Some of the affordability stuff, buying the mortgage-backed securities, pulled down the mortgage rate almost instantly. But then efforts like this against the Fed basically undo it. So there needs to be more coordination and thoughtfulness around, okay, as an aggregate, what does all this stuff do?
Now, PIMCO is weighing in as well with a bullish outlook, while Bill Ackman offers up an unconventional idea to help move affordability even further. Our markets correspondent, Nora Melinda, joins us to discuss this whole issue because you cover the housing market. And let's start with Ackman. His proposal was a tweet, right? Initially.
Right. So you're seeing people really trying to dissect what this means, as you're hearing really both the administration, also Ackman weighing in, PIMCO, all trying to figure out how to make mortgages more affordable. Now, when we think about Ackman's case, people are saying that this may fix the long-term rate and making that cheaper, but there are some pitfalls.
Let's talk about what he recommended.
Yeah, so he's essentially saying that he thinks that we should have prepayment. People should be penalized for prepayment on their mortgages. And essentially, we have heard this being laid out in the past, but there are some concerns that I'm hearing from experts and sources that I've been speaking with. They're saying this could potentially trap borrowers in the event that rates fall. So they're kind of stuck in this situation, but also it limits mobility. When you think about those that are going out to refinance, it kind of makes that a more difficult scenario to do.
It would be great for buyers of mortgage-backed securities.
Yeah, for holders of those bonds, if someone all of a sudden pays it off, and in a lot of bond contracts, you're not allowed. You do get penalized for prepayment.
Yeah, for sure. So it'd be good for them. And by the way, the president and his administration directing Fannie and Freddie to buy $200 billion worth of mortgage-backed securities is also good for this sector. It feels like there's a lot of policy. I mean, whether Ackman's thing comes to fruition is another idea, but it feels like there's a lot of policy tailwinds.
Absolutely. You're seeing the administration really trying to get creative because the issue right now for American consumers, voters, has been affordability concerns. That's what a lot of people are thinking about in this moment. So you're seeing the administration trying to find different vehicles, how to engineer, how to bring mortgage rates lower without necessarily relying on the Fed to cut, because we know that's been a sticking point right now for them. But when we talk about all these different methods that are being laid out, whether it be the 50-year mortgage that Trump has floated, or it be any sort of other things that we're talking about right now, we're talking about the fact that this could potentially boost demand, but it doesn't necessarily fix the supply concern issue that we know is a critical issue in the United States when we think about underbuilding. So that's what you're hearing a lot of people in the real estate market pointing to, is that we need to address the supply issue, not necessarily demand.
Yeah, a little bit of stealth QE. Hey, Nora, thank you so much for joining us. Nora Melinda on the latest on this mortgage market. Coming up, more on the president threatening new tariffs for Iran that could blow up the China trade truce. We're going to have the latest from Washington, D.C. This is Bloomberg.
All right, let's get a check on what's going on with the markets right now. After hitting all-time highs, we are coming off those highs, but still at 69.54 on the S&P. The drop only a third of 1% or 21 points. The Nasdaq 100 down a little bit more, with Nvidia falling 25,674 is a drop of 115 points. You do see the 10-year yield coming back down right now at 417. We were touching 420 at one point yesterday. And then oil, it's really interesting to see oil has floated higher, both on the NYMEX and the Brent measurements since we captured Maduro.
Yeah, well, today seems also concern of any disruption to Iranian oil, with the president saying that he's not going to be meeting with any Iranian officials as the protests under there.
As they continue to reportedly kill protesters, now more than 600, and reports indicate that they will also execute some of the more than 10,000 that they have captured. President Trump working against those forces. He is also right now heading to Detroit. Before leaving, he spoke with reporters on the tarmac, once again voicing his dissatisfaction with Fed Chair Jerome Powell, saying Powell does not do a very good job. Let's get the latest from Bloomberg's Washington correspondent Tyler Kendall, who is at the White House. President Trump, his administration, looking like it's putting pressure on Jerome Powell with an investigation opened by Jeanine Pirro. Do we get any more detail from the president about that?
Well, at this point, Matt, this White House is putting forward that President Trump did not direct or have knowledge of the investigation. As a person familiar does tell us here at Bloomberg News that it appears that the U.S. Attorney General for the District of Columbia, Jeanine Pirro, greenlit the subpoenas against Powell without consulting with her bosses at the Department of Justice. Still, it is clear that this administration isn't going to let up its pressure and President Trump's rhetoric when it comes to pressuring the Fed chair. This does come, though, against a backdrop of a broader pushback on Capitol Hill by Republicans. I know that you've been covering this on the program yesterday and today, but there is some significant pushback building that could potentially pose a issue for this investigation, as Republican Senator Tom Tillis, a member of the Senate Banking Committee, is threatening to block any nominations until this legal matter is resolved. Matt, we heard even more in the recent hours, including the House Financial Services Chair, French Hill, who is also calling this an unnecessary distraction.
At the same time, we have this split screen. The president talking, continuing to voice his dissatisfaction with Powell. Meanwhile, you're getting House Speaker Johnson and John Thune, the Senate Majority Leader, speaking on credit cards. Thune saying not advocating for a credit card interest rate cap. It would mean many lose access to credit. Johnson basically then saying a lot of work to do to build consensus on the credit rate cap. Tyler, does there seem to be any appetite from this Congress in order to push through this specific policy from the president?
Well, it does depend who you ask on Capitol Hill, Dani, and we do have to keep in mind that there is a very powerful lobbying group for big banks on Capitol Hill that are no doubt unhappy about this announcement from President Trump, but it definitely does pull on the more populist parts of the policy. We can say that there has been at least one idea floated that would put that 10% rate cap on. That was by Republican Senator Josh Hawley teaming up with Senator Bernie Sanders last year. We'll have to see if that legislation comes back around in a certain iteration. But to your point, this really does continue a broader theme of what we've heard from President Trump in recent days, floating a litany of ideas that he says are geared towards affordability. But the common theme is that he needs Congress to ultimately enact them, such as his proposal for a ban on institutional investors buying single-family homes. We'll have to see where it goes from here. Really, what Congress is likely going to do is that they're going to start to hold a series of hearings on this, start to get sort of a public feedback period before they start putting pen to paper on any potential legislation.
I mean, it's interesting to hear that, Josh Hawley is working with Bernie Sanders. It was interesting for me to hear that President Trump held a phone call with Elizabeth Warren, and she kind of made it seem like he was almost asking her for advice. Are we going to start to see more of the Trump administration working with people on the very far to the political left in order to put these affordability issues into place?
Well, it probably depends on exactly what the proposal is, but you're exactly right. Senator Elizabeth Warren telling us last night on Balance of Power that the pair spoke solely about the cost of living during their phone discussion. Also, probably worth pointing out, then Senator J.D. Vance once did pair up with Elizabeth Warren on a bill that would cut down on credit card swipe fees, something else that President Trump is putting to the forefront, elevating somebody else that was on Balance of Power last night, Senator Roger Marshall, who has teamed up with Democratic Senator Dick Durbin on a bill that would do just that. It does appear that this president is trying to move more towards his more populist messaging. We're probably going to get that later on today when he does speak at both the Detroit Economic Club, but also tour a Ford Motors factory plant where I believe they make F-150s. Matt, you probably know better than me on that one. But there's going to be this push when it comes to domestic manufacturing and protectionist policies that align with the sort of messaging that you're currently hearing from this White House.
They built a truck for me there once, Tyler. I know it well. And actually, I'm going there tomorrow as well. So Tyler Kendall in Washington, thanks very much. I will be headed to Detroit tomorrow night to talk to Jim Farley, the CEO of Ford, on Thursday morning, as well as Laurent Mekies, the CEO of Red Bull Racing and team principal. Hope you can join me for that. This is Bloomberg.